Hello, everyone, and welcome to Affinity Insurance Solutions. This is our first seminar for the year. And of course, the topic is investing because we wish to save taxes as the tax season is upon us. So let's talk about something that we all want to talk, RRSP and spousal RRSP, and maybe even TFS accounts. Our topic today is all going to be focused on how you can maximize your tax efficiencies. So let's take a look. To start with, we have a wonderful team of brokers, advisors that are well-trained, advisors that can help you make decisions that are important in your financial planning. And remember, every decision will essentially cost you money. A bad decision will cost you money. A good decision could make you money. So ask questions, approach us, and reach out to any of our team members. They will help you in the best way possible. That's our goal. That's our commitment towards you. So please always reach out, call to any of our expert advisors. They are here to help you out. Myself personally, I have been licensed in the industry for the last 15 years and helped hundreds of families and corporations get the best tax efficiency through financial planning. And a good financial planning requires time and understanding of concepts that matter. You are either employed or self-employed. You need to make the right decisions to be efficient about your own hard-earned money. You want to retain that. You want to keep the money that you have been working so hard for throughout the year. And you want to reduce and minimize your tax payout. And it's understandable. That's a human nature, and we all wish that for everyone, including ourselves. As self-employed individuals, we definitely also wish to have proper financial planning for ourselves. Our agenda today focuses on tax efficiency with tools and accounts like RRSP, TFSA accounts, and potential use of an RESP account. That being said, our focus today is mostly going to be on the RRSP, spousal RRSP, a little introduction to TFSA accounts, and we will have another full session in understanding how to maximize RESP and what it means to use an RESP account. For now, our point today is to focus on your retirement savings plan to get you that tax return that you want and make sure that that money that you have invested is well served in proper growth and in securities that you will feel comfortable with. So let's talk about RRSP. What is an RRSP? Well, let's simplify even further. Let's get started with the most basic of the concept. What is the savings? We wish to save money. Yes, we can put the money in a piggy bank, but is that really the growth that we deserve? A money sitting is definitely going down against inflation. So it's not just about having the ability to put some money aside. It's also that we want that money to work for us, to have the growth and to maintain a decent growth that it protects against inflation, as well as it gives you growth that you deserve over the long term. But let's take the most basic concept again. What does any investment require? There are two things that investments require. One is you need to put money, simple as that. But the key factor that we all forget is that any investment will require the most important component, and that is time. If you give investments time, then it has the potential to grow. If you put too much money and not have enough time, the growth doesn't exist. If you put too little and you have too much time, you might see a little bit of growth, but it might not be significant enough for you to live out your retirement on. So we need to find a balance and make sure that we have a significant regular savings and there is significant time towards us having a reasonable growth out of it. Because market can be speculative and each year is volatile. We have seen a pandemic year. Some of us might have even seen 2008, where the Canadian economy was on a crash. But on an average, if we look at the Canadian growth, if we look at the Canadian equity markets, we have seen a decent average growth within the equities, and they tend to be over 9%. So we want to keep a stable growth. We want to increase and maximize our growth year to year, but that doesn't essentially mean that we are going to get the same growth over the next 20 years. Therefore, we want to be consistent in our investments, and we want to be consistent in our performance over the long term within any investment. And we want to look at that benchmark and see that we are consistently doing well. That is the important part of any investment. Regardless, you put it in RRSP with estate planning, you can do corporation planning, everything requires the benefit of time. And one thing that you do not have over the age as you get older is more time when you are retired. So it's important to have that plan now than planning more towards your retirement. You are not going to get the maximum benefit out of it. So let's plan and let's think about how these accounts work. So how can we secure your retirement plan? The government of Canada gives out benefit programs within these accounts. These accounts are designed so that you can get some sort of government benefit towards that, such as registered retirement saving plan. The registered retirement saving plan is essentially a tax deferred option so that you can save your taxes and reduce your income tax bracket this year, while having that ability to grow that funds over the long term and withdraw those funds at a lower tax bracket when you're on a retirement. The other part can also be very advantageous is there is a spousal registered retirement account. This account is also very advantageous if we use it correctly. It can be beneficial for a high income earner in the household to use their limits towards the deduction and give out the funds towards the lower earning spouse. And over the retirement time, you can distribute that income. And we'll come to that topic once more. And again, TFSA accounts, most of us know them. They are tax-free savings account where the growth is free, but the deposit is a post-tax deposit. So be very careful in understanding that tax-free savings account is about having growth that is tax-free from your post-tax income. And of course, there are multiple rules, and we'll get into that detail. Last one, that we want all our kids to grow, go to university, and become good contributor of the society, and be able to make a decent living and live a good life. For that, they need to have proper education. And for that, we need money. We need to provide them the security of backing up financially so that they can make the financial or educational choices based on the financial strength that you can provide. And again, once more, the government of Canada gives out special programs and benefits within the registered education saving plan, such as grants. But on that topic, please follow us on our next video and a webinar where you will learn a lot more details and understand the proper leverages of an RRSP account. Going forward, let's talk about RRSP. So simple, RRSP is a retirement saving plan. It's a registered retirement saving plan because it allows the government to give you an option of growth. The growth is also tax deferred as much as your deposits gets tax deferred. It's essentially a tax deferred idea. The idea here is that I am making a decent income now, and I would end up paying a higher tax. But instead of paying high taxes, if I can end up saving a little bit of money, that can reduce my tax bracket and also give me the income tax back if I am an employed person where the employer has already taken out taxes from my income, I can get a tax return back. Or I can also have the opportunity to reduce my tax payout to the CRA if you are on a self-employed withdrawing salary or you had a limit unused from the past. Let's talk about what limits mean in RRSP. Limits are set by the CRA. It is set on an average at 18% of your last year's income, up to a maximum limit. The maximum limit is an overgrowing or changing factor that, again, based on the last year's taxes, the government decides what they're going to limit as. But most average individual can maximize their RRSP to the maximum up to 18% of last year's income can be deposited towards this year's tax bracket. You can also have an advantage that if you have any unused limits from the past years, you can all accumulate it and use it towards your future income. So it is a potential that if you're a young investor or a young person who is just starting out your career, you can defer because you are already at a lower tax bracket. You can choose to defer your limits when you want to use it at a higher income brackets. So let's clear that concept a little bit one more time. When you're at a lower tax bracket and a lower income, you do get your 18% limits from the CRA. But you might not maximize our tax return by using that limit. So we can defer the potential of using that limit at a later age when you are making more money. It's simple. So you can get better tax returns and better opportunities. Now you might be wondering, I just mentioned that if I start investing early, then I can get a better growth and a consistency over the years. Here is the advantage once more. You could make your deposit for this year, use the limit, but not count it towards your tax bracket when you are at a lower tax bracket. And use that credit again when you are at a higher tax bracket, which could be very advantageous when you are going from a tax bracket of being maybe at 20% to almost at 40% when your income is way above 100,000. You could get the benefit and plan it accordingly. And while that money is sitting inside your RRSP, it can still grow tax deferred and give you that compounded consistency growth that you would wish to have towards your retirement. So well strategied, that can be done. Now, if you are already on a high tax bracket, it's the right time to put that money. And of course, you want to use that deduction this year because you're already paying the high tax bracket. So any dollar you put, you can reduce your taxation based on the tax bracket you belong to. And you can get that tax refund back from the CRA when you do your tax returns. If you're self-employed and you have unused tax credit limits, you can also use that against your this year's income under the self-employed program. So use them wisely, understand the concept, and reach out. Of course, ask us questions. You can ask questions while we are live here trying to talk with you. So feel free to communicate and I will try to answer as many questions as possible and see what we can do to help you out. And there is no question that you might think is only applied to you. There are definitely chances that it could apply to a lot of other people. So ask away and we will be able to give you a generalized idea so you can make an educated decision towards your financial plan. Okay. Please. Let's understand what really means to be able to tax defer. and potential client, who could be anywhere between a 25% or a 40% tax bracket or even higher, has a very good potential of how to maximize their own money. Let's take a small example of a person who would be at, let's say, 40% tax bracket. They put $1,000 today in their RRSP. They have the potential to get $400 back on tax refunds against the $1,000, right? That 400 can also be reinvested in the right account, such as TFSA account. Or if you have young children, you can put it into RRSP account. And let that money also grow and compound and make you more money as you get older, and ends up saving you taxes, gives you more assets, more money in your pocket for you to manage. So it's a very good plan. It's a very good idea to keep some savings, maximize our tax efficiency, and defer as much as we can and get that tax returns that we could get. As you get older and you get to the point of withdrawing those funds from your RRSP, it needs to be converted into something called a RIF, Registered Retirement Income Fund. A registered retirement income fund can start any time after a certain age, which is around 55 with exceptions, or at age 65 and above. If you have deferred pulling out money or income from your RRSP, you will have to pull it out mandatory once you reach age 71. You must start withdrawing those funds and those income as you get older. Hence, it's not always best to put too much money inside RRSP either. We want to still be smart about it. We want to be careful about it, because if you have too much money inside your RRSP, that could also be a potential issue in the retirement time. Because if you're forced to pull out more funds from your own account, you're again going back to a higher tax bracket, and that tax efficiency has not really worked out on the best scenario, but it has still given you compounded growth tax deferred over the time. So we have to be careful of how to control our income now, as much as how we wish to see our retirement and how that planning will work out. At certain age, you might also not want to put too much money inside the RRSP, specifically if you're heading towards that 60 age and above. Depending on how much money is already sitting inside your RRSP, you might want to defer or not end up using those accounts, because you are putting yourself in a potentially higher risk of paying taxes as you retire. So we have to sit down with one of our advisors or with me and learn that where do we draw the line, and that line can be very different for each and individual customer or a client, because their lifestyle is different, their life choices are different, their plannings are different. So we want to make sure that your specialized solution is very specific to your need. We want to make sure that your life planning is not just about today, but it's about what happens in 5 years, 10 years, next 15 years, or up to your retirement, and see what your money does over the long term. That being said, there's also advantages of what happens to your money if the contributor has passed away. On that, if there is a surviving spouse or common law partner, then these funds can be transferred to the common law partner or spouse tax-free. The asset has been transferred. But this rule only applies to your spouse or common law partner. As soon as these funds are no longer going to your spouse or common law partner, and it's going towards your beneficiary, be it your children, be it some sort of support towards other family members, there is a tax efficiency that needs to be considered. One of the key problems that exists is that RRSP is subject to capital gains. So we have to again be very understanding about what the advantages are and how we can still leverage those advantages versus where they can be troublesome. And one of the factors is capital gains. Capital gains are subject to your growth and are deferred all the way towards your debt. And as soon as these funds that are balanced, they're calculated on an actual cost basis, and based on that, the beneficiary can see a potential tax pay from your assets. Your estate will end up paying those taxes before the funds gets released to the beneficiary. So sometimes when we look at capital gain issues, when you are already having a large chunk of money, you would be at a very high marginal tax bracket. And all this growth, all this hard work, all this money that you would have made and you wanted to give it to your kids can be at risk. So planning is the key element, and the message that I wish to provide you today is plan with your advisor. Don't make decisions that are immediate or just about this year, because those decisions don't only impact this year, they will impact over the long term as well. Other benefits of an RRSP can also be within accounts, such as first-time home buyer. If you're a first-time home buyer, you can potentially use your deposits up to $35,000 per spouse towards the down payment of your first home. I will get to the detail on that in a second, because we have this wonderful slide that tells us what we can provide you. So one of the key concepts that people are confused about is, what do I do with the money that's in the RRSP? Can I just leave it inside the RRSP? And the answer is yes, you can. You can just leave it in a blank without any investments. Is it the best idea? Potentially not. It could be a good idea if you're leaving it for a very short time, let's say 3 months to 6 months, because you are trying to buy your first home. Then it makes sense not to take the money in the risk market and try to keep the maximum dollar in your pocket, because it's a short-term idea. And you want to withdraw it because you want to do first-time home buyer. The other concept that you can also potentially put the money is in investments. There are different kinds of investments that you can do within an RRSP account. You can put the money inside the mutual fund, or you can put the money inside segregated funds that we offer. We offer segregated funds as we are an insurance broker. We also will be starting mutual fund in the upcoming future in the next few months, but our focus today is to give you an understanding where the difference lies and why you would choose one over the other. You can also put stocks or buy direct stocks, international equities or Canadian equities within an RRSP account. Remember, the RRSP is just a type of account. What you do inside that account is also very important, and it matters significantly. If you really don't wish to take any risk, you want to sit on a very standard low income, you can also put the funds within the fixed income series, such as GICs or even bonds that provide a very stable outlook and a regular returns consistently. So these are options that can exist within your RRSP account. But these options can also exist inside TFSA, can also exist inside an RRSP account, because they are tools of investing. They're not accounts. They are what you do inside your account. So be very mindful, and it seems to be a lot of confusion in the market as well, that people get confused that RRSP and investments, they consider them both to be the same thing. They are not. An RRSP is an account, a shelter under which you can do different kind of investments. So there is a flexibility that you can choose. It depends on your planning. It depends on what your future looks like. It's not just about making that, getting a tax return and not knowing how these things will impact you. So be very careful, think about them, and continue towards your planning. So benefits, as we talked about, is pay less taxes today, right? Because you have made the deposits inside RRSP, which has been used to reduce your tax bracket, has made you give the capacity to produce a lower tax bracket. So it's fantastic. It's a great advantage. You also would wish to keep more of your money by making sure you get maximum tax returns. By doing that, you can potentially also end up getting better child tax benefits. If you leverage it, you can potentially also end up getting other tax benefits that you could be losing by not using your RRSP. So think about it, look at your lifestyle, look at your family, and see what your real requirements are, because that's where the devil lies. We can all say devil lies in the details, or we can say the God lives in the details. I prefer to say God lives in details. So let your details make you the power holding capacity that you want. There are advantages in proper advice. There are advantages in proper leverages towards each account. So understand them, reach out to advisors that can help you. It's easy to make that call on our own and say, I will do the investment on my own, I will open the account because there are options now available online. But you might not be maximizing the true advantage because this is not your career. You are focused on your regular work, you're focused on what you specialize on. So let the experts give you the advantage. And these advantages are not small when you look at the long-term projections. We also talked about being a first-time home buyer. Again, you can withdraw $35,000 per spouse on your first home. Okay. Let's look at some of the problems that we have heard about what people have been advised. And there has been a lot of misunderstanding being a first-time home buyer and using your RRSP deposits towards that. So first and foremost, what you need to know is you need to leave that money inside your RRSP for at least 90 days for you to get that tax return back and take the advantage to withdraw the money within the first-time home buyer program. If it's less than that, you will be subject to taxation. So be very careful when you are applying these rules and placing the money within few weeks before you're trying to buy that property. And if there are advantageous rules that you can apply that will give you the benefits, but leave that funds at least for 90 days in your RRSP account. It's very important for you to see the real impact. Okay, so please consider that. One of the other concepts that we tend to see a lot from our clients, from our partner brokers, from our referral partners such as realtors and mortgage brokers. So here is a key feature that creates a lot of misunderstanding. I bought my first house, my wife can now buy a second house, and that would be her first house. Unfortunately, you cannot do that in the first-time home buyer plan. If you or your spouse already owns a primary home, then this withdrawal will not work for you on the second property. So please understand this rule is pretty clear that husband and wife are considered one unit, and that withdrawal is only one time on one primary home, unless you end up selling that primary home for over 4 years and you have no longer a primary home for more than 4 years, then you can reapply within the first time home buyer plan. But meanwhile, if it's immediate, it's your first ever, and you have not sold it and you're not without a house for less than 4 years, your spouse, if she's trying or he or she is trying to withdraw that fund, be very careful, because you will see the tax bracket and you will see an impact on that withdrawal sooner or later, and please plan that accordingly. So then we come to how to take advantage of that spousal RRSP account. How can I be a highest earner or the only earner of the household and maximize my tax returns while reducing my taxation during withdrawal? Moreover, if I'm a first-time home buyer, my wife is just new to Canada, I've been here for a long time, or both of us have just arrived into Canada, we have spent a couple of years of income, and now we're trying to buy our property, but the higher earner has a better tax bracket and the lower earner just started. So you can take advantage of the spousal RRSP. How would a spousal RRSP take an advantage? When you place those funds as a contributor into your spouse's spousal RRSP. Remember, it's defined as spousal RRSP. It does not mean that it's an RRSP owned by the spouse. It's a spousal RRSP owned by the spouse. Be very careful, because a lot of confusion and a lot of misrepresentation happens and client gets into a conflict with CRA or with the banks with the false advice. So be very careful and understand that this itself is a separate account that is owned by the spouse. So if I'm the contributor or the higher earner is the contributor, what is their advantage? Their advantage is they can use their tax bracket. While putting the deposit, they will get their tax deductions, which is fantastic. They are the higher tax bracket, they get higher tax returns. Wonderful, isn't it? Then what happens to the money? The money inside a spousal RRSP will belong to the spouse, except there is one catch. If the money inside the spousal RRSP is withdrawn within the first 3 years, they will go back as an income towards the contributor. So then that could increase my tax bracket and my income for the year, and I could end up paying higher tax bracket. So let's try to avoid that and use a proper leverage towards it. If you withdraw the funds after 3 years, and if your wife is a lower income, or even potentially you are planning for family planning, and those funds can be withdrawn after 3 years, and she could be at a very lower tax bracket. Fantastic. Now you can pull out the money, take the opportunity of tax returns, and still pull out money in the most tax efficient method. Because we don't want too much funds inside RRSP, but we want that tax return back, because it could be a significant benefit for us. So leverage a spousal RRSP accordingly. That being said, the 3-year rule does not apply to the first-time home buyer plan. So if this withdrawal or contribution that the person has made is pulled out on first-time home buyer plan by the spouse, it is not considered a full withdrawal within 3 years, because within the first home buyer plan, we have to pay back those funds inside your RRSP within 15 years. So we'll bring this concept more clearly again. In the first time home buyer plan, sorry about the slide change, we will continue talking about first time home buyer plan. So the first time home buyer plan, you have to understand the withdrawal limit that you have been given of $35,000 has to be paid back inside your RRSP over the 15 years. So 1/15 of that needs to be paid back, or you could be charged tax on that 1/15 income for that tax year bracket. So again, learn to leverage them, learn to maximize the advantages within them, and see how you can use these tools. Put that potential RRSP money into spousal account. Take the advantage of first-time home buyer plan and maximize your tax efficiency, even if you could not pay back because your spouse could be at the lower tax bracket. So significant advantages if planned correctly. Time matters, planning matters, tools and information that we can provide matters significantly. So take advantage, reach out to a proper expert in the field so that you will learn how to maximize your own dollar and multiply your own dollar in a long-term plan. This also creates a misunderstanding. One of the misunderstandings that I have dealt with from some of my clients is they understand that any withdrawal from an RRSP has to be paid back into RRSP, which is not true. So please consider this very carefully. Only the first-time home buyer plan or a withdrawal towards your education or higher education or second career education has to be paid back. Any funds that you withdraw outside these two programs does not have to be paid back, but you will end up paying taxes towards that year's taxable income tax bracket. Fair enough? So please understand that your RRSP money is accessible to you when you wish to withdraw. It's just a matter that when you withdraw, you will end up potentially increasing your tax bracket or paying taxes against that year's tax bracket. So withdrawals have to make sense. The first-time home buyer is a plan where the government is giving you a second advantage within the RRSP pool so that you can buy your first home. Okay. That being said, let's talk about TFSA account. I hope I've answered most of the RRSP questions. I hope I've introduced enough concepts about RRSP. We will talk quickly about TFSA account.
Hey,
Tax-free savings account.
Gautam, I have a question.
You do have a yearly limit. Unused limits can grow. While you do make a deposit inside a TFSA account, they are post-tax income. Post-tax income means that you've already paid income tax on that money, and now you are depositing inside these funds. But there are wonderful advantages of TFSA account. One, your tax on the growth is not deferred, it's free. Your capital gains inside the TFSA is also not deferred, it's free. Now, this can be a very powerful leverage tool when you want to grow assets. You want to grow tax-free assets, and you want to grow that tax-free assets on a compounded basis. That's the real advantage of a TFSA account. I've seen clients use TFSA account as if it's a savings account. It's not a savings account. It is a planned savings account. You have to understand the true power of a TFSA account is ability to compound growth without paying taxes. That is the true potential of a TFSA account. So if those of you are planning to use TFSA account as a once in a while deposit and withdrawing and depositing, you might be not leveraging the true benefit of it. And remember, you cannot put your growth back inside a TFSA account. Once withdrawn, it cannot be placed back. So you have lost that potential of compounded growth over the long term on the initial growth because you have withdrawn. You're only allowed to put maximum up to the limits that are set out for you. And the limits depends on when you arrive to Canada, or if you were born in Canada when you turn 18. All of those factors matter, but every year government assigns a limit, and based on a limit, you can have unused limits from the past, or if you are just turning 18, you can use this year's limit and put the funds in and start growing. Start planning for that future vacation you want. Maybe if you are a young person, you want to buy your own house, you want to find something that you want to reach out to as you get older, then TFSA is the tool for you to grow. If you're a retiree and you have funds and you maximize your RRSPs and you want to start having that fund that you don't need, you can use a TFSA account that can still continue having that compounded growth while not having the beneficiary to pay any capital gains. Fantastic. So wonderful tool, wonderful, powerful tool if used and approached correctly. So please understand the advantages of tax-free savings accounts, maximize those advantages, and see how you can leverage them. Okay. So once more, I'm going to introduce this. We will have our first RESP session on the February 26th, and we'll talk a lot more details because there are important concepts that need to be talked about. In summarization, what I wish the clients to understand is that there is an advantage towards an RRSP leverage versus an RESP. And a lot of parents get excited about putting funds into RESP for that 20% grant, maximum to 500 per year, maximum 7,200 per year for the lifetime of the child. Or if they are on a lower tax bracket, they can get more grants, and we will definitely talk more about it on the next session. So let's talk about those on the February 26th. Coming to the topic of what we do, we provide you segregated funds. So how does segregated fund work? How much are they different? Why should we consider segregated funds and not mutual funds? A lot of people are new to mutual funds, and now we are introducing segregated funds. That is a whole new concept and misunderstood. No problem. Here we have a small explanation to get your mind working towards why segregated funds. Most important, segregated funds is about security, stability over the long term. And how can we provide you security? How can we provide you stability inside segregated funds? Segregated funds tend to have guaranteed options. Your funds that you deposits can be guaranteed and protected against death or maturity. That benefit can be very powerful in a short-term planning situations. It can be powerful when there is a growth inside it and going towards your beneficiary against the loss of the market. So planning matters, importance of what and how much you want to feel secure about your own hard work money is very important. So please consider segregated funds as we talk a little bit more advantages on these things. Some of the key concepts and the differences that we want to talk about is these. So guarantees. What guarantees? Yes, your money can be guaranteed and protected. Your deposits can be protected. These tools are not provided if you are doing direct stocks. They are volatile. If you're doing mutual funds, the banks cannot provide you protection either. But segregated funds can. Segregated funds will provide you a peace of mind towards your deposits. It can also provide you the security towards your growth. Your growths can be reset. We call it resets, which are essentially a potential lock in your growth. What we do is, let's say you put $1,000 today, that is initially your death benefit guarantee, and it will be subject to maturity guarantee over the years. Normal maturity guarantee these days available is at least 15 years and above. So what it means is you have to keep that fund in your account for 15 years for you to see the guarantee advantage on it. Fair enough? The death benefit is anytime, therefore you are protected. There is a significant difference between what kind of guarantees you can get. You can get 75% and 75% guarantees, which means you can get 75% guarantee on death. You can get 75% guarantee on maturity. You can also choose 100 and 100. You can choose 100% guarantee on that, and you can put 100% guarantee on maturity. Again, fantastic tools if you know how to leverage them. Benefits of understanding the growth. And once again, I'll bring to the concept of $1,000 deposit. Let's say that $1,000 deposit for the next year looks like a $1,200. So now we have a $200 growth. And if I put a reset pin on it, that would mean that in the upcoming years, if something happens and the last highest reset was $1,200 and the market is lower than the reset, the beneficiary gets the last highest reset. So they will end up getting that $1,200. Fantastic. You can potentially protect your deposits. You can protect the growth inside it and have the peace of mind to not worry about what's going on with your money all the time, because you want to enjoy your life and focus on being what you wish to be with your family, do activities that you wish. That being said, there is again confusion regarding certain things of how these guarantees work. So if it's a maturity guarantee, of course, that $200 will now see an impact on the 16th year, and you will see the guarantee. One of the key concepts that you must consider is this, that resets only apply if the market is higher than the last reset. Resets will not impact your funds if the market is lower than the last highest reset. So that means that it doesn't mean that we are putting resets every year, even on a low market. We are putting resets always towards your growth, always towards that high potential income that has surpassed your last reset. So don't get confused. Don't have that fear that market once is down, now the new reset is at a lower amount. It is not. It is always going to be reset applied when the market is higher than the last highest reset. Clear enough? Awesome. Could we go back to the last clip, please? Sorry about that. Okay, so we'll talk a little bit more about other benefits of the segregated funds. The investments are protected against creditors. It's a very powerful tool to have if you are self-employed, business owners, or if you are in a financial crisis situation, then this can be a very powerful tool. The funds inside segregated funds are protected against the Insurance Act. They apply through the Insurance Act. Therefore, these funds are not accessible by creditors. Whereas your mutual fund or your stocks can be potentially leveraged against you when you are in a crisis against creditors. So, do you wish to lose all your growth and advantages that you have made over the years against one bad circumstances? I wish not. So you want to protect that money. And we can give you that under the segregated funds. Keep in mind, there's one creditor that this does not protect against, and of course, is CRA. So please make sure your taxations are paid or they have the access to the funds. But any other creditor is protected against this fund, which can be very powerful and leveraging if planned and understood correctly. It also increases confidentiality because it belongs to the Insurance Act. Any funds that you have invested outside a segregated or insurance act are subject to the estate probate process. And within the estate probate process, any person can go to the court on the deceased information and request the information, which means that if you have a family planning issues, if you have a situation that you wish to keep private for your family, then this can be a powerful advantage as well, because it keeps that information private. It does not belong to the probate process. It bypasses probate, which again is also an advantage because you could end up saving a lot of money. Probate process costs money. You have to pay the lawyers, you have to pay the judge, you have to pay the government to process your estate. Whereas because it's under the Insurance Act, the beneficiary is paid out benefit quickly, efficiently, because it's pre-assigned. They are predefined within the segregated funds, like a life policy. Therefore, it's again very powerful to have this leverage where your beneficiary can get access to this money quickly, easily, efficiently. Powerful to use if we know why we are using it. And last one, and the most important, is we want to know that what happens if the insurance company itself is not sustainable and I have placed my money with that. Well, the insurance company tends to have to buy insurance against the money and the deposits you have made with Assurance protection. Assurance is a government-backed plan where the insurance companies tend to have to buy insurance against such situations where the insurance company wishes to go bankruptcy. Luckily, it has never happened, yet this backup plan exists. In the last 200 years, that a lot of insurance companies that existed in Canada, most insurance companies in Canada are at least on average over 100 years old. None of them have seen any claims on Assurance protection, which is very well advantageous. Fair enough. So protect your money by insurance company, plus protect again, the insurance company is protecting you against your fallback if they themselves are unsustainable. And the chances are, if you have a good advisor, you'll end up moving those funds with that advisor to a different company way before the situation arises. But the foothold and the safety net exist. Go ahead. So let's talk about one key concept. This year's deadline is when? March 1st, 2022 is the deadline to put RRSP deposits for the year 2021. So if you wish to get tax returns on your 2021 tax brackets, please make your deposits by March 1st, 2022. Reach out to us, your advisors, and see how you can leverage these advantages. Okay, so I believe I have brought up some very key concepts for you to understand, and I've brought up some key elements for you to understand. That being said, I wish to talk a little bit more. We are running out of time, but we want to introduce these key concepts. I see there are some questions. Okay, it's related to TFSA account. So could you please go ahead? Yes.
Yeah, hi, Gautam. This
Hi,
is Sandeep.
Can you hear
Yeah,
us?
hi. Yeah, I can hear you. Can you hear me? Can you hear me? This is Sandeep.
Yes, I can hear you, Sandeep. Go ahead, please.
Okay, good. Yeah, the TFSA slide, if you can go back to the TFSA slide.
Please, yeah.
Can we have the TFSA slide, please?
Back. Yeah. Okay, I'll move out.
So deposits are post-income tax. What does that mean? Just wanted a clarity on that.
That's fair.
Yeah.
So the deposits do not provide you any income tax savings for that year, like an RRSP would. If you put $1,000 inside RRSP, you can get tax return against that deposit, right? But if you put
Okay.
funds inside a TFSA account, you don't get that back. You have already paid tax against it. Whatever income tax you have paid, you are holding your net income, and that's the net income that you're putting inside a TFSA account.
Okay, I got it. Okay, thank you.
Fair enough?
Yeah,
I
fair enough.
understand a lot of confusion there because the account sounds like it's tax-free, but it's not leveraging against the income tax like an RRSP would.
Right, got it. Thank you. Thanks for clarifying that. And also for the segregated funds, right? I have one
Yeah.
question. Is there any capital gains tax on yearly gain? But you don't withdraw it, I think, for 15 years. I think that gets locked in for 15 years.
It's
right?
not locked in.
No?
Again, a misconception that exists.
Mhm.
The maturity guarantee lies in the 15 years, but your funds are accessible to you if you need to withdraw. And based on whatever portion you withdraw, you could have the guarantees change accordingly. So they will look at how much funds were there, what was the growth, and based on that ratio, they will change your guarantee in the 15-year mark. But you have access to your funds. These are not locks. Some of the key mistakes that people understand is segregated funds or mutual funds or certain things have locks in. A GIC, a locked in GIC is definitely locked in. But an RRSP within a seg funds or a mutual fund is not locked. The penalties you are seeing is really not coming from the fact that it is from the account itself. The penalties are usually seen because of the sales charges. And I wish to bring that concept now. And if we can take that few minutes, just give me a second. Slide there.
Yeah.
Yeah.
Okay, so I'll talk about it. Okay, the MER cost is divided between the management of these funds, the fund managers, of course, the commission of the advisor that works with you, and the operating expense. The operating expense has two factors, of course, basic operations such as paperwork, clerical work, and those elements that gets added. And the last part is taxation. Now, taxations within any funds or MER is very diverse and variable. The reason is a fund could potentially have got dividends, and the growth, majority of the growth inside that fund has come from dividends. And if those dividends are eligible dividends, then the tax bracket can be lower. If those funds and the fund's growth has come from the buy and sell of those assets within the mutual fund or segregated funds, then the taxations are different. So the tax is not an exact plan tool here. It depends on what's happening with that fund and where the sustainability or growth is coming from. All of that factors matter. It also matters what kind of equities that we have chosen. If it's a bond income versus an equity income, is it a straight fixed income from money market? The taxes can change. But in general concept, these are the factors that are rated. Of course, if you have a lot of funds and you can make higher deposits, you can end up saving on MER cost, and you can make deposits that are well managed at a very low MER cost. But it comes down that you need to have a higher deposits, generally over 100,000 to 500,000 or more, and you can end up saving more on the efficiency on the MER cost. I would also like to introduce the other concept, and the other concept is sales charges. The other way around. Okay. The sales charges is where the sales misunderstanding happens with the client. The client sees a penalty on withdrawal. Client sees, why am I getting charged so much? All of that comes from the advisor and the person making that sale, more than it's coming from the portfolio managers or from the fund itself. So where the problem lies? The problem lies in understanding what these sales charges are. Front-end load is basically an idea that any deposit you make, your deposit will have a sales charge that will impact immediately. Example is, if you make $1,000 deposit and the front-end load charges are derived, then you will end up seeing, let's say front-end load charges was $50. Then what you would end up seeing is your balance on that account, or a starting balance on that account, would look like $950. So that's what front-end load means. The front-end load, the advisor has charged you an upfront fee, upfront commission for your deposit. The other one that tends to be the most notorious one is the deferred sales charges, or DSC. Deferred sales charges are the most difficult and most hidden elements that people face in banks, or even with a lot of competitive advisors. The problem here is, if you have $1,000, you have placed the $1,000 in your account, the advisor has been paid a higher commission. Okay, they have been paid. But if you withdraw that money in a short time, let's say within the 8 years in general, you as a customer ends up paying the charge. So the advisor still ends up taking the commission home, whereas you as a client will end up paying the charges that the insurance company or the banks have applied and paid it to their advisor. Because they don't want to lose, they're going to put it against the customer, which would again mean something like, if you put $1,000, your deposit shows $1,000, but if you withdraw within 2 years, you might end up only getting $900 in your pocket from that account when you withdraw. So it's not a very good plan. And this is where a lot of clients see, oh, it was a locked in, I got a penalty, or segregated funds when I withdraw for my first time home buyer. I end up paying too much penalties than the growth I did. People tend to say all these challenges they face, but the reality is it's the advice that they were given, and advisor was more interested in their benefit over the client's benefit. So clients need to be more aware of this element. One of the other things is that there is a compromise. There is a nice place where both the client and the advisor can be happy. And that is considered low load or a no load charge. A low load is either I charge you significantly less, it is not taken out from your deposits, but the advisor is subject to how much commission is paid based on how much or how long that fund stays in the account. Other option is a no load with a chargeback. So you don't get any load on as a client. So you are not charged any fees. You're not subject to the advisor's paycheck. But if you withdraw, the advisor has to end up paying their commissions back to the provider, but the client does not suffer. So that would mean that the client stays in a positive impact, knowing that advice is made on more of a client basis and not in the best interest of the excuse me, not in the best interest of the client. I apologize. What I meant to say is that decision is made on the best interest of the client and not the advisor. And if the client is provided a decent advice, is provided well advised, decent growth, long-term planning, then advisor is likely going to see the client retain and come back to them when they need the next advice. So we feel at Affinity that this is the right choice for us. This is where we sit normally. And in the last 15 years that I have been in industry, this is where I have placed most of my clients. It depends, of course, on the client's needs and planning needs of that client as well. Some clients and business owners might need a separate planning. So we look at it a little bit differently for them, and that's a specialized approach as well. Does that answer your question, Sandeep?
Yes, it kind of answered the question related to withdrawals and then what the charges are. And you explained about MER and how we can make sure that we don't get charged for that, right?
Right. So you
Yeah.
as a customer need to ask these questions, but unfortunately, to ask these questions, you should also be aware of them. And that's where we wish to empower you so that you can take. We would wish you bring the business to us, but we want to still empower all our clients, all our visitors, so that they know how they are being charged and what their penalties are against. Right? So locked in is a very misunderstood concept other than GICs. In GIC, it's a straightforward concept. The longer you keep, the more money you would get. If you break in the lock-in, the less money you get, you end up paying penalties. There, it's simple, but within mutual funds or segregated funds, it's not as simple. And most important, do not be afraid your money is accessible to you. It's your money. Do we have other questions? Definitely reach out. You can also call one of our advisors on this number. This is direct line to our office. You can email us on these email address as well and ask questions. Please, we would love to answer them.
Can these presentation be shared or the recording itself?
We would be uploading them. Unfortunately, the last end of the MER costs and things have not been recorded because we had some technical difficulties to change the slide, but we will upload the most of it, and we will do another session and we will re-upload it again. So yes, these slides and this information will be uploaded on our website soon. Okay.
Sure, thank you.
No problem. Do we have more questions? Okay, I see a question here. Not sure who is it from. So the question is, why would segregated funds benefit? Again, segregated funds benefit comes from the fact that if you use a right advice, then you can potentially make more money. The other factor is, if I give you the power to secure your money, you're likely to make more aggressive decisions. And in investments, the more risk you take, the more returns you can get. So if you have protected your money, then why wouldn't you take the higher risk and make more money? Does that sound fair? It can be very calculative, but we can make the advantage that that little high MER cost against the protection can also give you the leverage against the growth. Because if you put it in a mutual fund, you might want to not put everything in high equities. You will put something in balance. You would put something in fixed incomes. Whereas if you put it in segregated funds with 100% guarantee, you are more likely to take those funds and advantages and maximize advantages within equity, because your funds and your deposits are guaranteed, your growth is protected. So, and that growth itself can be much higher. Oh, wow, okay, I'm back on. That growth can be significantly more higher and reasonable against that little MER cost differences that we tend to see. At 75% and 75% guarantee, the difference is even significantly less between an MER cost with a mutual fund and a SAC fund. On a 100, it is a little bit more, but we get to leverage those benefits. And the last and the most important that we did talk and we touched the point is you are not in the field doing that. And if you are, that's great. Yes, Quest Trade and Simply Wealth and all these online tools can help you. But if you cannot react fast enough when you are at work, let the experts do that. It will cost you a little bit, but it will make you a lot more if you can trust and have a trusted advisor with you. Because this is their daily job, this is their daily requirement. Yes, so the funds inside a mutual fund and segregated funds are very similar. The portfolios can be matched. The portfolios we can find to match it. We can find multiple solutions with different companies. So you're not losing out with that idea that mutual fund has more options. No, segregated funds can also have these great options. The only difference is we are a little bit more particular about what kind of funds have been invested. And we want to look at those very carefully. And I can share one of that factor right now. Can we show one of the segregated funds fun fact, please? And if somebody thinks the growth is not enough in segregated funds, that is also not true. You can see they will show you a fund from Canada Life. We can also show you funds from other companies, but I believe this is the easiest one to understand and read. Okay, that's sunlight. Okay, no, Canada Life. Thank you. So here is an example of what segregated funds looks like. Okay, so we're sharing the screen with you now. Okay, can you see it? So here's an example of what a segregated funds within a US equity looks like within Canada Life. So 2.95 is an MER cost, or normally on a mutual fund, we tend to see around 2.29 or 2.3 MER cost with mutual fund versus SAC funds. But the funds are very similar and you can take advantages of those tools. If you see down, the funds are mostly distributed with the market that you want to have the maximum growth in. Because the Canadian market has not been very stable over the years, we tend to look at a little bit south to justify our income and give us the growth that we want. The sectors that it's allocated is also very important, and it's very changed to the market, such as if we knew the pandemic was here, we knew that it was going to last a little while, putting lots of money or some of your money in some healthcare sector would definitely give you a better growth because we know that's in demand. So changing market is very important, and knowing where these markets deposits matter in part of choosing our funds. And can we go down here? And here is something that I wish to show you. Here is the top 10 holdings of this fund. Keep going down, please. Very good markets: Microsoft, Apple, Amazon, Google, Tesla, Adobe. All of these guys were very stable within the pandemic because most people end up using that. If we go down, let's look at the average growth on that. If you look at their 10-year mark, the average growth is way above 9%. Last year's return was significant, 16.5%. 2020's return was almost 32%. 2019, we had 28% returns. So we do see a good portfolio, well-planned, chosen timing can give you a very high growth. But because the market is speculative, and then you can see this year to just in January, we have seen a drop in the market. It's volatile. So we have seen a loss. But even with a loss like that, if we can have time and leverage time and leverage the ability to have that average growth about 9% or even 9%, we can be very well set off. The growth on a 9% compounded could be well worth over time. And it can mean a big difference. So it's not just about saying that I got growth this year and not next year. What we want to achieve is long-term planning, and a stable growth about or around 9% would be fantastic. Any further questions?
So this 9%, where is it showing actually in the?
It's not showing, it's what the average on equities have been over the last 50 years in Canada.
Okay.
We don't want to give you very false hope. We tend to keep that benchmark for ourselves and be realistic to the clients that we cannot give you 32% growth every year after year. It is unrealistic. Markets will change, circumstances will change, economics will change. Time can be very harsh as much as beneficial. So we want to average out and make sure that we sit when we look at portfolios, we look at the long term, that they tend to stay within that benchmark of 9% and keep our clients happy.
Okay, is this 9% after deducting the MER? Yeah, maybe it's about 2.95% here, right? On
okay,
this one.
So that's a very good question. Love the question. The returns you see here are net of MER. Okay.
Okay.
So you are not taking the MER cost out of these funds. So I would take an example here that in 2020, this fund shows a return of 32%. But in reality, this fund produced way over 35%. Right?
Okay, got it.
9% was taken out, and you're seeing the net return of 32.3%.
Yeah, that's great. Thank you.
Yeah, it's fantastic. So even when you're looking at segregated funds, it's not just looking about MER costs. When I'm showing the returns net of it, why would a little difference matter when I'm talking about security and still similar returns as a mutual fund?
Yeah.
Okay. Do we have more questions? Well, since we have answered everyone's questions, if you do have more specific questions, please reach out, call us, and thank you so much for taking the time to listen to us. And hopefully this.
I'm sorry to interrupt here.
Oh, yes,
My
sorry.
friend
Yeah.
Rahul, his mic is not working. He has a question. He's asking what if his wife withdraws the money after 3 years, if he puts the money into spousal RRSP?
Okay, so again, very good question. After 3 years, the withdrawal is considered your spouse's income for that year. So if that withdrawal is lower than the minimum tax income bracket, then you might not actually end up paying any taxes, or you might have to apply for a tax return back if that fund during withdrawal, that fund has charged you taxes. You can apply back for that tax return and you would end up getting that back. If the withdrawal is a little bit on the higher side and do end up paying a tax, you might end up paying a little bit of tax, but it still could be a better savings withdrawing at a lower tax bracket early on than to wait till retirement, because you can leverage a TFSA account, take that money, put it in TFSA, and now you have growth that's tax-free and capital gain-free over the long term. So benefits if planned correctly.
So
if you have more questions, you can write down on the chat as well if your mic's not working, and we would love to answer that as well.
His next question is, what if 1 minute. Rahul,
That's okay, take it.
oh, sorry, it's clear. He got
No,
it.
that's okay. So I hope that answers people's question. This video will be uploaded. And again, once more, thank you very much for everybody who has taken time to join us today in this wonderful seminar. And again, I hope that this information has empowered you to make the right calls and maximize your money. So please, thank you very much, and visit our next seminar on RESP on February 26th. Thank you.
Thank you.